Welcome back to the Steps to Soul podcast. Today, how to save money when selling your business. Business owners, there's some counterintuitive truths here that you may think where you save money is actually not the place to do it, and we're going to tell you today how to do it. Right, Chris?
Absolutely. I'm going to talk about several key points of when you can really kind of engage on trying to save a dollar and what's probably not the best time to try and squeeze a buyer or squeeze a broker. And so going to cover all those topics and more.
You're right. Every owner asks the same question, really, Chris. How do I either pay less in fees or, where's the real money lost when I sell my company? But really, most of it's lost, 2, 3, even 4 years before, which is, I think, sometimes kind of hard to digest for a lot of owners. They feel like, the conventional assumption, I'll just, save a percentage on the broker point, or I'll ask the premium price above premium, but I'll settle for premium and I'll squeeze the buyer on every detail on the contract. I'll make them pay my legal fees and I'll make them pay this fee. And reality, man, the places where the owners really lose money, which we've talked about before, but maybe not in this exact style, is unreported income, really poor company structure, and really just a lack of early preparation versus negotiating 1 point on a fee or closing costs at the closing table or paying for appraisals. It's amazing how many owners will fight over the pennies and not look at all the work that can be done the 3 years before, where the real money is lost, where the real value can't be defined, where the real value is chipped away at by buyers in Q of E, in diligence, and when lenders show up, when they say, what do you got here? So today we're going to flip that script a little bit. We're going to kind of show owners, and as you mentioned, we're going to get some good points on all sides. And hopefully, for whatever it is out there, for those of you listening, buyers, this is just as important to you. Because when you see an owner has done what we're about to instruct them to do, this is going to make your deal a lot more achievable and deal you can actually execute on, because the material is going to be there to do the deal. So let's talk about the first myth, Chris. For me, it's easy. I'll save money on the fee. And before everybody likes to bash the brokers in the room doing the podcast, I've seen time and time again people say, well, you got to get your fee down. And I say, well, why, Chris? Why is my fee negotiable? If I'm going to give up immediately my work property, all the good stuff that we do, how am I going to negotiate for you? And it's amazing when I tell owners, they kind of look at me and go, well, I didn't think of it like that. If you can bully me on the first meeting, how am I going to stand up for you? I don't mean to sound, condescending, but let's think about that. If you can just push me around and be a yes man, your company's never going to get sold, right, Chris? It's good luck. Good luck.
Yeah, it's absolutely one of the most common misconceptions I hear. If they can reduce fees or handle that part of the process, they think they're going to walk away from a deal with more money. But what you and I both seen over and over is that sellers who focus too heavily on minimizing fees, on our fees or whatever other fees they have to pay, legal fees even. Yeah, exactly. They often miss much larger opportunities, whether it's in valuation or deal structure, negotiating. The fee, it becomes a very small percentage compared to the much bigger financial picture of the deal. I mean, Brandon, tell me, how often do you see sellers focusing on saving such a small percentage in fees while unknowingly leaving like a much larger amount on the table? How often does that happen, either in your deals, or how often do you hear about it happening?
It's funny. I see a lot of times, we get a lot of comparisons. Well, I could use a realtor for 6%. I'm like, you're welcome to. And you're going to get a sign in the front yard. And this is not a smack at realtors, but their strategy for selling companies is not as effective as ours. You can go down the list and look in town. They throw the name on the website. They put a sign in the front yard. They don't have the business financing the background. I don't care if the realtor even priced it correctly. They don't know how to finance it, how to structure the deal. So it doesn't matter if you're trying to save a few points. What ends up happening is you're on the market, it doesn't get done. And what's the end result? Your company didn't sell, you didn't get paid for it. And I see that time and time again. And I tell people, you're right. As one of my guys once said years ago, the realtor gets the benefit of the sign advertising it. We do confidential advertising. We have to work through different modalities to get exposure, to get qualified interest. We also know when we see poorly written LOI and language in contracts that are going to be a problem down the road. You're the working capital guy. We're going to touch on that later. That's a great example of one issue that the average realtor has not dealt with, and especially in a pure business sale modality, not just business and real estate, but just a pure business itself. I've also seen, too, the owners that do that, they want to go the cheapest option because they want to feel like they won a battle, that they got something, that they got some negotiation leverage. When I tell them is, okay, you're welcome to go get something cheaper if you want. But ask them how many companies they've sold, ask them for their comps and what they've done. I guarantee you 99 out of 100 will not be able to put what our company can put on the table. We've done 900 deals. If someone has done 900 deals and knows what they're doing, I applaud you for going with them. And I see a lot of companies too charge upfront fees and say they're going to apply it towards the close, but they don't have to sell your company. If you gave them $20,000, $30,000 up front, but only for a smaller commission on the back end, they're not incentivized to work. They've already gotten paid. As you and I work, we work completely non-retainer based. That matters. And I think a lot of owners try to flip that script and do that. And what happens is, almost every owner I've ever talked to, the second they wrote that check, trying to save on the commission by paying an upfront fee, regretted it. Every single one realized I shouldn't have wrote that check. 99 out of 100. It's just trying to save a little bit here does not mean your company's going to get sold. And honestly, it doesn't really incentivize the person to do something either. But let's talk about this, Chris. Where is the number one issue that owners can do to prevent down the road? Not talking fees, not talking negotiating that. It's the most obvious answer in the world. And we're going to say it again to the top of the mountain. Unreported and misreported income. Especially in service industries, especially in cash-based businesses, you have got to report your income. It is amazing how many laundromats, car washes, and other service businesses, restaurants, bars, if they had just reported the cash, Chris, you and I could have sold probably 50% more. But because they just don't report the cash, we cannot show it for financing, and it completely destroys value. Does it not? Does it not just cripple our chances to help?
No, it absolutely does. And I'm going to tell you what unreported and not reporting cash is. It's a bad habit. It's a bad habit that probably started when the business started. Because when the business got started, you were strapped for cash. You were trying to save every dollar. You were just trying to get off the ground. Those first 3 years were probably the hardest you've ever been through in your life to get your business going and get employees in place and get the cash flow started. And you started this bad habit of, hey, if I don't put this cash in the bank account, I'm saving 30, 40% on income tax, whatever tax bracket you're in. And that bad habit never went away. You started making $300,000, $400,000 plus of cash a year. Of income and profitability, and you didn't stop that bad habit because you're still thinking of the tax savings. And I tell you it's a bad habit because I've talked to owners who have come to me well in advance of when they want to sell, and I advise them, you've got to stop doing this. And then I talk to them years later when they're ready to sell, and did that bad habit start? It's just like smoking or drinking. They just kept doing it. They could not stop.
Kept doing.
At some point, you've got to draw a line in the sand. Even if you started it long ago to bootstrap yourself and get the ball rolling, you've got to stop that process because it's going to cost you dearly. And Brandon, I'm going to let you talk about the mathematics of how much it's going to cost a business owner. But it's going to cost you so much when you go to sell your business if you're leaving a lot of cash off the books, off the financials, just to save 25, 30, 40% on income tax. I know that sounds like a big percentage, but in terms of value, what is it costing, Brandon?
More than they realize. And we jokingly say you can't steal it twice. God, you got a decade of stealing it, but the last 3 years you got to show it. We had a customer come in just early this year in a promotional products business, was taking 40, 50 grand out in cash. How do I know? I'd look at the P&L, look at the tax return, and every year that same income number would just flip about the same amount every time. Had that number been shown on the tax returns to do lending on for the last 3 years, one, the multiple would be stronger because the cash flow historically would have been higher. So at a 3.5 multiple at 50 grand off the value, that's $150,000 to $200,000 in lost value to go to sell that company. That's retirement income gone. You just threw away 6 figures because you just didn't want to pay a few small bits in income tax. And there's ways to run it through the business with expenses to help. I mean, it happens more and more and more, especially for smaller companies. If you're doing $1 million, $2 million EBITDA, it's not going to affect you that much. All right, this is more for smaller businesses. It's really going to hurt you because you already have a small enough window for debt service capacity repayment. And when you crush that by taking cash out or not reporting it, you set yourself up for failure. You know, I'm working with a company now here in town. I told them last year, it's a family business. You got to report the cash. And about maybe 3 months ago, I was grabbing a bite to eat, ran into them, and they said, hey, we started taking your advice. We started doing it. We're going to get it on the books. I'm like, good. Keep it up. And it doesn't, just 6 months isn't enough. It's not enough. It's got to be at least a year because lenders are going to see that uptrend, and it's going to help with your financing. You're exactly right, Chris. And for those of you listening, it may be the difference between you even selling your company or not, if it's
So
even
true.
financeable. We had one business, the husband passed away, the P&Ls were no good, the wife who took over didn't know what she was doing. The only way we were to even sell that business, because we used AI to track how many wash cycles there were, and the buyer showed us this on a machine. So he could somewhat backwards do the math. But some businesses, you can't backwards the math and feel comfortable. He knew that buying his business, even if it's a cash-based business, not much was being reported, his goal was to buy it and report the income, because he knew then he could sell it for a much larger number in 4 or 5 years and really flip his investment. But like we tell everybody, you cannot ask someone to commit I'm not consider a crime, but a bad act to facilitate a business continuing in the future. That's also part of the problem. And that same goes for not reporting salaries too, Chris. How often have we seen that where, I just paid this guy cash on the side. He's part of my team. You cannot ask someone to facilitate that. That is a very, very, very bad idea. And you want to talk about scare a lender off when they hear that? Good luck getting financing. Done deal. Not going to happen. You also put yourself at the mercy of that employee who's on cash reporting you. So if there's a stock sale involved, good luck. Because that owner's not going to inherit that the new owner's not going to inherit that liability. So please, if you've got unreported cash, whether you're pulling it or paying someone under the table, you need to report it. You don't know how much it's going to hurt you down the road. And that also affects profitability in the financials too. So get it right. Let's kind of dive in on the next bit real issue. And that's company structure and equity setup. The way you set up your business for tax purposes does matter, right, Chris? Whether it's an LLC, sole proprietorship, partnership, C Corp, we could go down the list of all those options. But I see too many people trying to optimize just to reduce to pay taxes. And I'll stress this, similar to the cash component issue. Yes, nobody wants to pay taxes, nor do Chris or I. But when you just basically churning this company into showing zero profitability and it's all into places and money being moved and funny business, you're killing the value of your company. Yes, you didn't pay tax, but income not showing and can't be verified means it can't be sold. I see companies with $4 or $5 million in revenue showing no net income. I know the profit's there, but you're messing with the books, right, Chris? And what does that do to the real value? How can we work around it? But how much does it also limit us at the same time that we don't have just clean, straight up numbers right in front of our hands?
Yeah, it could be a 7-figure loss on that, right? You could be losing all the
Easily.
value of multiples of cash flow in your valuation, and you're knocked down to basically asset value. The assets of the real estate and the trucks and the equipment that you've got. But at that point, somebody can't go to the bank. Yeah, they may pay you for that if they can have the cash on hand, but they cannot go to a bank if you've got zero as your net income or negative even, and go to a bank and say, I want to borrow money to buy all this stuff. The banks they love collateral, don't get me wrong, but they love cash flow just as much.
You're right. And I was talking to a company in Florida that their accountant convinced them to change to a C Corp from an S Corp.
Oh, wow.
And I said, now, if you do an asset sale, you're going to get waxed.
Yes.
Stock sale, you're okay. But asset sale, you're going to get double taxed. And they went, what do you mean? I'm like, a buyer may not want to do an S Corp. A stock sale with you. Because you've got a lot of projects outstanding in previous work done, and you don't have a lot of contractual projects in the future. So by buying that stock, they're inheriting the risk. And they were kind of like, well, what about asset sale? I'm like, you're going to get double taxed. Well, what do you mean? I'm like, ask your accountant. You were an S Corp. You should have stayed an S Corp if you were going to sell in the next 2 or 3 years. If not, when you convert to a C Corp, you need to do some extra steps to make this a reasonable stock sale down the road, because otherwise you're paying way more in taxes if it has to be an asset sale. And you're not set up right now to be a stock sale based on what you've done. And you mentioned possible liability in our discovery conversation. Well, if there's liability and the stock sale's coming, Chris, you know what's about to happen. Buyers are going to step back and say, no, thank you. I'm not doing this. I got to see what's going on.
Yeah, you're exactly right. The way a business is structured during its growth phase is often designed to minimize taxes, right? That's
get off the ground, right?
Yeah, exactly.
Survive.
That's why the CPA recommended whatever structure he did to do that. But that same structure can create a lot of challenges at your exit, like you mentioned on the C Corp being double taxed. I think the problem is many owners don't realize as they're going along in their business that there's a trade-off between tax efficiency while operating in flexibility when it's time to sell. So address that early. I think that honestly needs to be addressed probably 5 years before you're ready to exit, maybe even 10. Maybe it's not time to do it yet, but you need to understand the
implications of it.
Changing tax structures in your entity, it takes a little bit of time sometimes, and sometimes you have to have the perfect timing to make that switch. However, if that's not addressed early, it can absolutely limit your options to reduce what you're going to walk away with after the sale. So
Mm-hmm.
be thinking about that as you're kind of into your business, not something at first couple of years, you're fine. But as you get 10, 15 years into your business and you're starting to see that exit in maybe 5, 10 years, start talking to your CPA and have a plan of what needs to happen to limit your tax liability. And maybe you might need to change structures.
You're right. And I would also frame this question to your accountant. If I were to do an asset sale or a stock sale, what does my liability look like? And then think about what is going to affect your ability to get those two sales done. I mentioned the company in Florida I spoke to. Remember, stock sales, you inherit the liabilities, but also typically AR, AP, because we can go into a whole bunch of other issues with that. But if your business is not set up and properly documented to record the AR, the AP, your balance sheet isn't properly updating monthly, weekly, yearly, we can go down the list of issues. Some sales won't even be doable because the documentation is not there to properly structure it. And now you have to go back and a buyer may do a Q of E. Well, if that's all gets redone and you realize that's not what you thought your business was because you weren't keeping proper books because your structure didn't allow you to do that too. And that's also a massive, massive barrier to a lot of owners that we just recommend you look at. And especially if you're getting close to sale time, like you said, 3 to 5 years out, start thinking about eliminating some of those items you put into your structure that are, are trying to help you with, like maybe the company car, maybe the life insurance policy, maybe some items that you don't really have to run through the business that I understand you want to run through it. But is it really saving you that much money and making the business look less efficient? Is that worth it? Yeah, we can add it back, but come on. The more you have to add back, the more likelihood the deal will not go through, especially the smaller your company is. Yes, if you get $3 million EBITDA company, having your car run through the company, no big deal. But if your SDE is 2, 3, 4, 500,000, and we got to start talking car, life insurance, going down the list, Chris, and adding back 10, $100,000, $200,000 in items, that starts to get everybody a little tense. Lender, buyer, it just creates a level of doubt. And also, you have to verify it. So if you're not good at record keeping, just get it out of your business now. Because if you can't come back and verify it, you're costing yourself more and more and more as the day goes on. So we've kind of talked about reporting the income, mentioned structure, and we kind of hinted at this too, kind of our next main issue, early preparation and operational cleanup. This is probably the hardest one to do because, as you said, you started growing the business, you kind of built your structure, you kind of built your habits, your team kind of has a culture. But that culture right now may not be the one in structure that should be in place when it's time to sell. And what does that mean, Chris? Every dollar you spend here really cleaning that up could be a massive return. If you've got people you can delegate roles to, or promote, or help mold, start now. Every buyer wants a business with more competent employees and higher levels of management that can handle multiple roles. If your business is dependent upon you or one manager or one employee that has one license, you are putting your business at a disadvantage to sell. It doesn't mean it won't sell, but it will be a disadvantage and it will hurt you. This is the kind of items that if you've been training people and you've got long-term employees, if they can be promoted, do it. If they can be elevated, try. Try now. Don't say you're going to do it 6 months before you sell the company. You just promoted somebody and you hope they're going to work out. Right, Chris? Like, you may realize that guy never had it.
Right.
Get those systems. Get those employees elevated. What else would you recommend?
Preparation, you're talking about that, but that's where a lot of value is either created or lost. You're exactly right. Businesses that go to market with clean financials, documented systems, less reliance on the owner, they're going to command a stronger multiple, a stronger valuation.
Mm-hmm.
And on the flip side, businesses that go to market with unresolved issues, that's the biggest one. If you know your business has some type of issue in it, whether, some people don't even know what their issues are. They actually need a third party to come in and probably take a look at their business.
That's okay.
Yeah, that's fine, but you need to do that. I have one now. I've had a client for a while now. They started out, the owner's mom and dad were doing their accounting, and God bless their hearts, they've passed away, but they were doing the best they could with QuickBooks. They had done the books for their church, and so they came in, they were helping the owner. And his business started out doing maybe $500,000 the first year, quickly grew to $1 million, $2 million, $4 million. Now you've got mom and dad doing books on a $4 million revenue business, and basically what they're doing is just kind of keeping the general ledger as straight as they can and letting, seeing the ins and outs, but they were not tracking manufacturing costs, or we're not tracking, employee wages versus labor and all that stuff. So when I came in, that was one of the first thing we did. We had to bring in basically a CFO type person to start not only organize all their books in a way that actually was for manufacturing, but to start addressing how much are your cost of goods actually costing you. He didn't even really know. He was making so much profit, which was great.
They're just
Any business
happy.
owner would love
And that's
that.
okay.
That relieves a lot of your
But
problems. You don't really have problems if you're making so much, money that you really don't need to worry about this. But he was able to improve margins, able to see what his cost was, and going to market. If a buyer comes in and they see that you don't know all that stuff, they're not going to value either they're not going to value the business as much as you are, or they're going to try and take advantage by pointing things out that you don't even know about your own business. And so it's just important not only to clean up your financials, but understand your financials, understand your business, understand every aspect of your business. That way, when a buyer comes in, they can't tell you what you're doing wrong or what you're doing right. You already know, and you can tell them. And that's part of the valuation process is kind of giving all that information and saying, and here's what my asking price is, and I know this about my business. That's a great kind of way to go to market, is understanding your business inside and out.
It provides transparency at the early stages of a deal, which we talk about a lot of times.
Yes.
When a broker can identify these issues along with the sellers, present them. If they're issues, they are issues. And some can't be resolved right away. Some can't be just hit the switch and it's gone. But when you can present them up front and show you factor that into the valuation, it creates trust in the metrics used to bring it to market. And that builds buyer trust and goodwill. And that goodwill is what gets your company sold and gets people to feel okay about moving forward. I had a hard conversation earlier this month with a family who had a very nice business in Mississippi. The husband and wife owned it. They're up there in age. The wife passed away. They stopped looking at items. And I understand why. I do. I lost my dad in our business. It's very hard. You don't want to look at other stuff when that happens. And the son was talking to me, and I'm like, what happened to your processing fees? Nobody looked. The contract renewed. They were paying probably 30% more than they should. Crushing cash flow. I told him, we got to clean up this company. You have a good business. You should be making a lot more money. You've got to clean these issues up and get it on the books. And that's not going to happen in 1 to 2 months. It's going to be a 6 month to a year process to show the rebound from that obvious answer that I can say would be the quote, a red flag to point out. We had a death in the family, which caused some issues. Everyone understands that, but everything else is in place. But then we start saying, let's talk about your margins here. You're getting crushed on past salaries and payroll. You got a lot of people. I'm like, well, we sold your competitor down the street and had half the employees. You've got to cut some of this fat if you want to get that number up to get where you want to go. And I'm sorry the valuation you got from somebody is so grossly off, you should throw it in the trash can, and I'm sorry. I mean, it was off by almost, let's say, probably 300, 200%. That's how bad it was.
No, that's crazy.
It was. Didn't factor out PPP, went back 5 years, used a 5-year average. Even the sales had declined. You can't do that when the sales, and there have been some obvious reasons. There was the COVID bump era, and that all switched, and we can get into those nitty-gritty another day. But it was not having too many employees, not keeping their eye on the ball, allowing their systems to not be in place properly. And I told them, they said everyone knows their role. I said, that's awesome. But do you have it written down anywhere? Well, no, they just take care of business. I'm like, that's great company culture. But you need to memorialize that and get it written for the next person, because the next guy coming in may not know that Joe knows to do X, Y, Z and that Sarah knows to do A, B, C. You need to have it written down. And it's amazing when I tell owners to go back and write your systems down if you haven't. They start seeing their own flaws in their company that they didn't realize were there and start addressing them. And they start going, oh my gosh, we have all this work we can do to optimize. Yes, do it. Start that process. Let us know. So when we bring the buyer in, it's not during due diligence. Oh, I didn't realize you didn't do this. I didn't realize you didn't do that. I didn't realize this wasn't going right. I got to renegotiate the price. I need to retrade. You know that conversation is coming, Chris. And we're trying to say, when we go to market, we've done everything we can addressing the good, the bad, the ugly, and the great. This is why we're asking this, and this is why it's a fair price. And when owners shoot that logic down, I tell them you're going to have a very hard time selling. Or worse, you're going to get told you're worth X by a buyer. They know that coming in, they're going to swoop in behind you, and then they're going to chisel you down. You want to save the money? That's where you're going to lose your money. The buyers that come in and nickel and dime you down because you didn't bother to take the good advice you got up front. And as you know, Chris, the more time on the market, the harder it can be sometimes. It's okay to find the right person, but it can get harder if you don't have things properly set up. Or, I'm going to throw this out there too, not letting your proper advisor speak with your other advisors. That can be your CPA as a seller, your attorney, your wealth advisor, whatever. We need to be in contact with this team and make sure everyone's on the same page what this is going to look like. It's amazing how I've given valuations to a business owner. We did the listening agreement the next day. Well, my wealth advisor says I can't retire. I can't do this. I'm like, I explained the best price you could possibly get, and you said that was fine. And now you're telling me there's a misalignment on your retirement plan? All that for a few $1,000s? I'm like, you get the frustration in my voice, not because I wasted my time, but because it's a lack of understanding what you have on the cards on the table too. Be organized, be structured, take care of business, and get things in alignment, and you'll be a lot better off for it.
Right.
We've kind of talked about fees, Chris, but I want to talk about them a little bit more right here, because I know people can say, oh, you're talking about your points, what you get paid. Yeah, we get paid. There's a reason why. But it's not just our fees that sellers get upset about. Maybe it's the fees from their accountant, their lawyer. There's the right time to engage the right advisor in a deal. And there's a right time to, I would say, pay that advisor for their time. When it's time to organize the financials and get things organized, yes, your CPA needs to be involved in providing that. No, your attorney does not need to be involved the day you sign the listing agreement, per se, 24/7 running up a bill. However, there are times you're going to have to spend money. And sellers that refuse to engage and allow this to help really handicap themselves. Chris, you can speak to a specific deal you've been working on for a long time. The owner would not let us get in touch with the CPA because he was afraid to run up a bill.
That's right.
Multi-million-dollar EBITDA company. We're talking multi-seven-figure payout. And we just need to have a few questions answered by the CPA. And what happened, Chris?
Yeah, we needed to reorganize the financials. He was reporting on the cash basis, and we'd done the valuation on the cash basis because that's what we had available to us. But we kept having larger private equity firms come in. And what did they want to do? The first thing they want to do after they get introduced to the owner and ask their questions up front is they want to do a Q of E or some light due diligence, and they want to convert the financials into accrual. And rightfully so. They want to see when the cash really came in, when the bills really needed to be paid, and what the monthly cash flow of this business looks like so they can understand the net working capital and just the cash component of that business. Well, I wanted to get ahead of it. And so what that requires is the owner's CPA reconstructing the financials. And he was just resistant to doing that. And not because he didn't want to pay for the whole project or have this done. He believed that it needed to be done because we had spoken to enough buyers who kind of expressed their concern on the financials and what they were planning on doing. And I didn't want them to beat us to the punch of seeing what was out there. So I wanted to make sure that we understood it first before they did. And just over like maybe $1,500 or $2,000 that it probably would have taken his accountant to do what we needed to do for the last 3 years, just resistant to that. And that kind of mindset, you're looking at what does this cost me instead of what you need to be thinking of is what is this return? What am I going to get for investing this $1,500 or this $2,000 or even if it's $10,000? I know you and I are talking about having some larger companies do Q of E's, pre-Q of E's prior to even going to market. And
Doing
yeah,
one
those
right
things are
now.
going to be costly, minimum 7,000 up to 15, maybe even 20,000.
Depending on how many entities, correct.
Larger companies. And you got to stop thinking, what is this going to cost? It's going to be, what is the return? How am I going to understand my business better before buyers come in so they're not sitting there dinging me for things they find? I'm more giving them the information they need, and I'm getting what I'm asking. What do you think of that mindset and owners constantly thinking, what does this cost me? Brandon, do you see that? I know you see that as much as I do. How do we make that shift of getting them to think of the return that they're getting for this?
What I try to explain to them, and I give them, I think, the best information they can make a decision on, is no one can guarantee you what your company is going to sell for.
That's
but
right.
Would you rather have a 15% margin of error or a 5% margin of error for your expectation?
Yeah.
By that saying that.
Yeah.
It's $1 million company. Would you rather fall closer to 950 to $1 million or fall 850 to $1 million? You're not going to want to lose that extra money. You mentioned QV Prep. We have one we've been working with for a while. And we told him his books are June to June, not your traditional January to December. So we're talking a whole different kind of fiscal year, a whole different kind of accounting. Switched accounting firms midway through within the last 3 years. So some of the books are being done differently. There's different amortization schedules. There's a whole bunch of different strategies. And we told the person, you're going to need a QOV. Your SDE is going to be somewhere between 700 to 900 based on what we can truly verify and make sure is accounted correctly and normalized. At a 3 to 4 multiple, that's a heck of a lot of money, Chris. Say it's $200,000, you could be looking at $600 to $1 million in value added back to the company if it can be verified and proven. That's worth $15,000 to make that return. Minimal 5 figures for potential multi 6, even possibly 7-figure return on your total walkaway. Especially if you start factoring in some seller financing, other return down the road, that number can be stretched to more and more of a return. And I understand not wanting to spend money. I'm a business owner, as are you. We understand that keeping costs down keeps money in our pocket. But there are times you need to spend a little bit of money to get things cleaned up properly. I see the same thing with fee negotiation for us. Well, if you come down 1 or 2 points, I'm like, yeah. So I should work for less than my value to get you a better price, to get paid less. That's counterintuitive. I say, I don't go to your business asking for a discount when I grab a bite to eat or buy a product. Why should I give you a discount, right, Chris? Especially when I tell people I work for free up front. We get paid at close if we sell. So I'm taking all the risk and all the leverage. I think that's a fair argument. And I tell people, if an owner's also willing to be, when I hate to say it, I don't say to use the word cheap, but resistant to spend any money, how are you going to get through a deal when it's time to start paying legal costs?
Yeah, that's a big one.
Those get expensive, especially with bigger companies. You use someone like Jones Walker, you're going to spend multi-6 figures. It's going to be expensive for certain deals. At the same time, I've seen people get mad because we had to email the attorney an item. Don't email the attorney. Yeah. They need the document. Right. I don't know what I want us to do. If money's that tight, there's a bigger problem you're not telling us, and we need to understand what's going on so we can properly help you. We could give you 100 examples of stories we could talk about, but the real simple point here is when you tell someone, I just don't want to pay fees, you're telling somebody, I don't want to pay someone what they're worth, and I don't want to engage the proper people to get my deal done. So you're already admitting to everyone in the room you're willing to take less for your company because you're not willing to do what needs to be done to get it correct. That's what it really means. And it's a hard thing to hear from someone like me, I'm sure, as a seller. And same for a buyer. If that's the kind of owner you're dealing with who won't spend money and won't get stuff done, they're going to, honestly, I don't love that mentality working with them in the future if I'm you. I don't mean to be negative. We've seen some scenarios like that where the owners just don't want to cooperate. Buyers, take note of that when you look at that. So we've covered all that. When is the right time to do everything, right, Chris? We mentioned 3+ years before the sale. Yeah. We mentioned all these
well in advance, right?
Types of options. Really,
I think one of the biggest advantages a seller can have is time.
At the latest start.
And when owners start thinking about a sale in 2 or 3 years in advance,
take care of business.
What they have is the ability to change all those bad habits we talked about before. They have the ability to get their financials correct, get their operations in order, align that structure that we talked about. That sometimes that does take years in advance. The runway that you have available, it's going to create options for you. So if you start this 6 months before you want to sell, you probably don't have enough time to get everything correct or get things organized. When everything is done at the last minute, those options are so limited. You just, like Brandon talked about earlier, if you got to make a change in your system, it's not going to reflect in 3 months or 4 months. It might be 6 months minimum. It's probably going to be more like a year or 2 years. And so that's the difference of kind of having that runway of time to really get the process started and change the things that need to be changed.
So let's discuss the next main issue. And we've kind of hit it a couple times throughout the podcast. It's the timeline. When do you want to start and when to do what? Realistically, 3 years out is ideal. Is it perfect, Chris? No. But is it a good starting point for most people? Yes. Realistically, most people don't really reach out to someone till they're really ready or maybe a year out. What I will tell you, sellers, is this. The earlier, the better. The earlier, the better. And I'm going to repeat that again because it's so important. You might be surprised what we can set up to get you going. The only thing I will warn you is that even though you can get a valuation done and we can give you a proper setup, the only thing that can realistically change that's out of your control are 2 things. Interest rates and the financing contingencies that are out there. For those who don't know, the SBA did change their SOP back in June of 2025. And that threw 90% of deal structures that were being used to the market. Just threw in the trash, right, Chris? So even if you prepare, it's not a guarantee. But you'll be surprised 3 years out how much a difference that can make. 5 years is, I think, ideal. 5 years is like the perfect scenario. You know it's coming in 5 years. You're getting ready. But if you see a trend forming in your company and you have concerns, I would say reach out to someone like Chris or myself right now, because we can tell you what that trend might look like and what the repercussions of it, good or bad, could be for your company. If you've got that upswing and you're 2 years into a major upswing, you need to call us now.
That's right.
You need to call us. Don't wait for it to go. I'll give a good story. The gentleman's been calling our office for over about 5 or 6 years. Has a dealership. Was rolling, making a fortune, Chris. Yeah. He's down, was around $7.5 million in sales. He's now down to the low fours, back up to 5 the next year. Cash flow, disintegrated. Yeah. It's not even sellable. It's truly not.
Wow.
And as you know, when you have floor plans, lenders do not like floor plans because they're assets they can't tag and have control of.
That's right.
And it's heartbreaking to hear someone say, well, I thought I was going to get more from my retirement. I'm sorry, but years ago, you had a multi-seven-figure business. I don't know if I could get you more than the value of the assets a couple $100,000 right now.
That's crazy.
It is.
But it's truth.
And he was calling, doing the right things, asking for advice, and we're telling him, you should come in. You should come in while it's hot. You should come in. No, I'm going to hang on a few more years. Imagine seeing 7 figures evaporate in front of your face.
I see it way.
It's
tough.
I
see it way too often. I've mentioned many of businesses I've been working with over the years to you, and you know them. And I hate to see that. I haven't seen that yet, but I have a few that I wish they would have moved forward and listed, because I see the trend. I see where they've grown and grown and grown, and I see they're getting tired. In their later 50s, early 60s, it's like you're not going to be able to sustain what you've done for the past 10 years to this degree for the next 5 to 10 years. You're going to hit 65, 70, and the market's going to change on you. Something's going to change. And I'm not saying you've got to sell, but if you're interested in selling and you're just hanging on for, we've talked about that, one more year. If that's kind of your reason for not selling is just give it one more year, you're playing a very dangerous game. If a broker comes to you and says, this feels like a really good time. You've got 2 really good years of increase over increase. Buyers are going to love that. They're not going to know how high this thing can go.
Rates are down.
It's the opposite when you're falling. Yeah. I've got 2 businesses right now I've been working with. They're down about 26% on one, 30% on another year over year. And I tell them, buyers hate that because they don't know if this is a falling knife. They're not willing to catch it, or they're not willing to pay a premium value for sure. And so you listen to your advisors. I mean, I guess a lot of times I come in and tell somebody that it's a great time to sell. And then I hear their CPA says, don't you ever sell this business. I'm like, that can't be the plan, right? And just to never sell the business.
Well, sounds like someone doesn't want to lose a customer.
That's
what it really
right.
sounds like.
So when I say listen to your advisors,
I don't
you
got to
listen with your own gut instincts about what the intention of. And I get it. Like if I'm sitting there telling you to sell, why? I'm a broker. I've got to have listings. I got to get you sold. But I've told many people. I have told many people it's not time to sell, or I can't sell your business right now, or here's what you need to do. So when I tell somebody to sell, hopefully it comes with some truth behind it. Well, it does for me, but hopefully they see the truth that I'm giving. Obviously, they don't know me the first time they meet me, but I can tell you I've told many people when it's not time to sell. So it's not always sell for me.
No, probably a third of my conversations with that, honestly. Exactly. If I think back on it, probably a third, if not maybe even more, is, hey, this is not the time to sell. Here's what you can do. And I would much rather tell you that now, a year and a half away, you make corrections and come back and we can help you do better, because then I do better. It's true. It's a mutually beneficial relationship to do that for you. And on top of that, even if you've gotten 3 years returns already, you've got the P&Ls done, but we've got some issues. If you've got time to hang on and actually fix it, and there's a realistic reason why it went down, not just, hey, I got old and tired and stopped caring, but we had a death in the family, or we had a natural disaster come through, whatever. We can work around that very well, people. We can. It's not going to change what happened, but it gives more substantial evidence to go and say, hey, this is why it's an issue. At the same time, I'll stress this. When you're on top, you need to really consider selling. And I know that means, hey, I may not have a plan, or I could definitely hang on 10 more years, like you said, Chris, but I'm tired. Go back to our earlier part of this conversation. If you've got long-term tenured employees that have shown potential, that is the time to elevate them. When the company is up, when you feel a little bit of tiredness set in, start structuring to minimize your involvement in that decline of your involvement from hurting the company. Because that could buy you a few more years to sell, but it also will add great value to your company in the multiple and having those other highly trained and key employees in place. But if you're the kind of person where you got to run the shop and you got to be in charge and you're starting to get tired, you need to call. Because if you're going to get tired and slack off, that company's going to follow your directive. I see it time and time again with smaller operations. Bigger you are or you're growing, get people underneath you, delegate your roles. And the time to do that is really 3 to 5 years out. Get them in place. But if you feel that fatigue coming, take action. We can still help you earlier, but take action.
And I tell a lot of business owners this. I tell them my favorite type of deal structure for the ones who aren't really ready to walk out the door, but they've had those 2 years of growth. They're getting to the end of the road. I tell them we can find a buyer where you can sell a majority of the equity, 75, 85%. You can hang on to a piece of it. You can help continue to stay on and help that business grow, but take that bite of the apple. Take that big bite out of the apple and make sure you lock in that value of your business doing really well for the past 2 or 3 years, that you're getting close to retirement or wanting to do something else, next chapter of your life. Let me find a buyer. It doesn't have to be 100% you're out the door in 30 days. It doesn't have to be that way. My favorite type of deal structure is actually where you stay on board for a while and then you help the company grow and make sure all the training and transition and your 30 years of knowledge, however long it may be, is legitimately
Memorialize
transferred.
your work.
Exactly. You can't do that in 30 days. You can't do that in 6 months sometimes. But stay on board. I had one a couple of years ago where I did like this. He could have stayed on for 5 years, but he got to the end of, I think, 2 or 3 years, and he said, listen, I'm really done now. And that's a great way to walk out the door, knowing you left everything on the table. The business is doing really well. You've got everything in place, and the buyers are happy because you stayed on and all knowledge was transferred and the business is doing great.
Correct.
So when you're thinking about timelines, you need to realize it doesn't always have to mean that when you sell is the day you're leaving the company. And a lot of times it's not in larger companies.
No, you're going to be tied in for a while. And that's okay. That's okay. What I will say, too, is we talked about timing. The last thing I want to touch on for everybody listening, and maybe the most underrated value when people negotiate, and this is not going back to negotiating fees, but a point I want to highlight specifically. The right advisor for deal structure, what you try and negotiate a point or two on their fee, could save you multi six figures. You and I had this conversation just earlier this month about a working capital trick a company tried to pull on a previous deal. Because you were there, you saved that owner from getting stiffed basically $1 million.
Over.
This is straight up. This is what it would have been. It would have been an absolute steal of $1 million.
Probably closer to 2.
Imagine trying to tell somebody, I can't pay you a half a point or a point on the sale value to lose 7 figures.
That's right.
Think about that. No. All because a sharp, sophisticated, private equity-backed buyer was trying to flip the terms of the agreement signed, not honor them, and basically play with the math for the timing of a seasonal business sale.
For sure.
And that's why you start early, because when you come to us with, for example, a seasonal company, we're going to address that concern and show you times to sell, issues you're going to face. And you may think, well, my season's done, time to sell. No. It's time to get ready for right before that flip time, sir. That's the best time. But to get to that point, we have work to do before we go to market. So if your timeline is sensitive to those issues, we need to be addressing that and leveraging that point to go to market, right, Chris? And I think sometimes owners just want to hit the switch and be sold. It's not like selling a house. And I've seen owners also push back for over a year. Well, I'm not ready. I can't do that for you. Change your fee. I'll do something. I'm like, no. Because if you want to sell, you're going to commit to wanting to sell and do the right steps to get there. If it's, I'll call you in a week and it takes 6 months to call me back, you're not ready to sell, and I know that. And I'm not interested in engaging you if you're not fully intent on doing something either. I want to help you get out too, but you have to be committed to doing it as well. And Chris, I'm sure you're the same way with me. The longer you do this, the pickier you get, because you see people that don't want to fully commit. And nothing's worse than telling a buyer, yeah, they wanted to sell, we got them listed, we did some good stuff, and then they stop providing documents. They stop doing the right things. That's where you're losing money too. Let's talk about that a little bit. Once you're for sale, the job is not over for a seller. You have to keep being a part of the transaction and producing. Nothing's worse than getting all the right information, Chris. You get it listed, you value it properly, and then, God forbid, I can't get a damn P&L. Talk about engaging your CPAs and get it going. There's no excuse for that. And that's where you lose money. Not negotiating my fee, not negotiating with the buyer, not producing documents. We've had a large daycare for 3 years listed. Had they produced documents multiple times in advance, it would have been sold in less than probably 6 months. But it took 3 years.
Wow.
And they were doing fine, but they were tired, and they were fighting. The owners were fighting. There was issues. But had they just got their bloody act together and paid someone to fix the books rather than one of them having to do it after hours when they were tired, not in the mood, install for 4 months. Ask for P&L in April of the first quarter. I get it in October. The buyer's been gone for months. I told you the buyer's already walked months ago. What do you mean? What do you think was going to happen? Again, so don't be cheap when it's time to do the right thing. Even a little bit of money spent on a bookkeeping service to get you up to date and aligned is important. When the deal is still going on, you've got to maintain that cost. We have costs too. You're not the only one taking on cost. However, it will make you a lot more money on the back end. Responsive financials, responsive sellers are the ones that get stuff done. Ones that recluse and argue and worry about every dollar spent, I promise you, you're never going to get your company sold because there's always cost incurred in selling a business. Whether you use a broker or not, there's going to be CPA costs, attorney costs, probably some other updating costs if there's property issues or remediation, whatever it may be. There is cost. So just accept that. But do the right thing now and make a big return on your investment. This may be your biggest asset you own, right, Chris? This company may be your retirement plan. Why would you worry about pennies to make dollars with it? I'll end myself on that. I'll die on that hill.
Yeah. I think if there's one takeaway, we've been talking about how people want to save money, but it's not really, at the end of the day, it's not about saving money. If you're
Not
trying to
saving
save
money.
money, then you're doing the wrong thing.
Creating value.
It's more maximizing value, right? It's about preparing smarter, preparing in the beginning, or having that runway to start preparing. I would say this: the owners who net the most amount at closing are not the ones who worried about minimizing fees. I've seen it time and time again.
No.
They're the ones who built businesses where the buyers could easily walk in, trust what they see, finance the business, and that's ultimately what's going to drive the best outcome for you gaining maximum value for your business.
What's our favorite word, Chris? Transferability.
Transparency, transferability, all of them.
That's what you just listed. It's funny, when you try and hold back, that's when transferability gets squeezed. And when that's what gets squeezed, that's where value is lost. That is exactly where it goes. Because when it isn't transferable, it isn't verifiable, and there's resistance, it's like pulling on a rope. Buyer and seller both want to go in the same direction. But if you're pulling back just to pull back because you don't want to do stuff, that buyer's going to say, why am I pulling on the rope? Why am I trying to get you to come help me, right? Why are we trying to cross this thing together? You're obviously giving me resistance. Let you go. You go fall in the water. Like, hey, it's true. It's absolutely true. And the same goes both ways. If a buyer doesn't want to incur any expense and wants to be cheap, sellers, be careful. Same way. A lot of the similar issues go both ways. But we hope you understood today why we're saying where to save money and what matters. Because at the end of the day, it's the preparation and the key steps you take where you really save money. Worrying about the stuff right at that time it's time to list is not the time to worry about those costs. It's okay to be mindful of them and be open to it. But preparing in advance, preparing documentation, preparing company structure, having the right advisors engaged at the right time, and then being engaged throughout the process even once you list, increases transferability, increases money to your bottom line, increases buyer confidence, and increases your walk away. Your total consideration, your total value of the transaction, as I always say. That's where money is made.
Great point.
And there we have it.
There you got it.
We'll end on that because I don't think I can say anything else better than that today. And if I do, I will certainly text you, Chris. And if you want to find out what I text Chris, you can follow us because I'll probably make something funny about it later on if y'all want to see. Shameless plug. But as always, this is the Steps to Soul podcast. I am Brandon Bourgeois. That is Christopher Sater. We hope you have a wonderful time listening to the podcast. Subscribe. Follow us on YouTube, Spotify, all the good places. We'd love to hear your comments. We'd love to hear your thoughts. Any suggestions for topics? We're happy to talk about them and share our insights. Remember, we're here to give good advice and be for lack of better words, the anti-influencer narrative. Real business advice from real business sellers who've done this for multi-decades. I'll see you later, Chris. You have a good one.
Take care.